Many responsible founders know that this is the end of the year and it's time to write off your taxes. And this is probably the only period of this year left that when you can do really something to minimize your tax base legally, and so write off those expenses that probably can save some of the amount of money that you can reinvest in your own business. And the question is, how would you do this? How would you keep this money to put it back to your business? And here today with me, we have Tigran Harutyunyan, the tax advisor who works with many companies, helping entrepreneurs and many other corporations to legally report their taxes, to support them with their tax filing services and many other accounting and something else that needed by the business. So you guys take away this headache and focus on becoming the best solution for your customers, and we'll take care of the rest. And here today, Tigran is going to discuss exactly the steps you probably want to do to write off your taxes yourself. Hi, Tigran. Good to have you. And let's get started.
Hi, Daniel. Thank you for having me. Yes, so in today's video, we'll explore some of the most common expenses you can do to take advantage of and reduce your tax liabilities. All right, so obviously it's December, it's the end of the year, and hopefully your business made a lot of money and you can just enjoy your New Year holidays and enjoy your profits until the time when IRS comes and takes that money. And they will take it with all these taxes: corporate income tax, payroll tax, state income tax, which is done by the franchise tax board, but it's still the government, or self-employment tax or franchise taxes, which is also the state, right? And even some taxes, some strange abbreviations, which are actually taxes that you have to pay. In the United States, we have more taxes than there's stars in the sky. So luckily, if you're smart about it, you can take advantage of the business-related expenses and reduce your income and therefore your tax liability. So what are business expenses? Any expense that is directly related to the operation of your business, right? So it's not a rocket science, right? So if you buy a pen that you use for your business, you can write off as a tax expense, right? So you spent $5 to buy the pen, you made $100 in gross income. Now your taxable income is only $95, right? So you buy paper for another $5, now your income is $90, and so on and so on. And the end of the year, when you file your taxes, you will only pay tax on your net income after all business expenses. Now, before we jump onto the most common business expenses, it is important to understand the notion of cash and accrual. Now, most businesses will use the cash method. However, there is some merit on also discussing the accrual method. So cash, you spent money the second you actually gave money away. So if you went to store and bought a printer for your business, you spent $100, you gave the $100 today, that's an expense today, right? So you can write it off today, as of today. So if it happened in 2022, you can write it off in 2022. However, if, for instance, you got the printer today, but you are paying monthly for your printer, or your payment is not due until January, that will be an expense in 2023 if you're using the cash method. With the accrual method, however, you can deduct an expense even though you haven't spent money yet, right? So basically, you buy something for your business, you didn't pay upfront, but you can still deduct it. You spent $100 to buy a printer or $200 to buy a printer, you can deduct $200 today. And even though your payment is not due until, say, January of 2023, you still can take the full $200. Now, the disadvantage of the accrual method is that you have to use the same standard for counting your profit. So basically, if you send an invoice today to your client, even though your client hasn't paid you yet, even though your client isn't paying you until 2023, you still have to report it as an income. So simply put, there's no good answer which one is the best. However, you need to understand the difference, right? So if you are using the cash method, and you can choose it, so this is totally up to you, but you can't change it, right? So so if you choose cash, you have to use cash pretty much for the rest of the year, right? At least. So basically, if you are going to account for your income the second you receive the money, not when you send the invoice, you will do the same for the expenses. However, if you want to do the accrual method, you can do the other way as well. Okay, so that's pretty much what cash and accrual are, right? Now, let's go to the most common types of expenses, right? So let's start with the car. This is one of the most common ones, and I get a lot of questions from my client. Okay, if I buy a car for my business, can I deduct it, right? Well, the answer is yes. Now, there are some complications, right? Obviously, if you're a huge, large corporation that has like 20 cars working for it, so you probably only use those cars for business. However, if you're a smaller business, you most likely, chances are higher, using your car also for personal use. Now, IRS understands it's difficult for a business owner to calculate things like depreciation, gas, oil changes, maintenance, insurance. It takes a lot of time, so it offers standard mileage method. So let's discuss what's the standard mileage and what are the actual expenses. So standard mileage is an easy way to deduct your car-related expenses. What you simply do, you take all miles driven for business and you multiply it by a standard mileage rate. The rate is given by IRS. It's available on IRS's website. As of 2022, all miles driven between January 1st and June 30th of 2022 can be deducted at 58.5 cents. From July 1st until December 31st, it's 62.5 cents. So simply put, if I drove my car that I use for business for 10,000 miles, or let's say 12,000 miles, and 10,000 of it was for business, and 2,000 was for other things such as like personal needs, commute, etc., then I will take the 10,000 miles driven for business. I will multiply by the rate. All the miles driven before July 1st by 58.5 cents. All the miles driven after July 1st, 62.5. Now, this is not always the best way. This is the easiest way, but not always the best way. Sometimes actual expenses may give you more deductions. Actual expense means you will take the car depreciation, generally 1/5 of the car price, now plus the maintenance, such as oil changes, tire rotation, etc., plus gas, plus insurance, times miles driven for business divided by all miles, right? So when it comes to depreciation, now obviously there are some other ways. If you talk to an accountant, they will show you how to take actually a larger depreciation during the first year the asset is put in place. But overall, in general, to put it simple, because this is not an accounting webinar, right? It's just a crash course on expenses. We'll say that depreciation is 20% of the price. Now, other car expenses are interest you pay to the bank if your car is financed, the parking and the tolls, right? So parking and tolls only when you are driving the car for business, obviously. And with the interest rate as well, you have to multiply the interest rate by the percentage, by the proportion you drove your car for business. Now, second one is the business use of home. This is also a big one as well, especially when more and more people work from homes. Now, it's important to understand that the space in your home, in your house, must be used exclusively for business. So if you are working from your bedroom, just like me now, you cannot deduct your rent or your mortgage as an expense for your business, because that space is used for living as well, right? So a very classic example of when you can use your home for business is a dentist that uses his or her garage to see patients, right? If garage is not used for anything else, right? Or hairstylist who uses their basement for seeing clients, right? So it is very clear to any reasonable person that this space is used as a hair salon, the space is used as a dental clinic. And in those cases, you can actually deduct that space as for business. However, if you're just working from home, that does not qualify as tax deductible expense unless you have a clear space for office at home and it's not used for anything else. And it's very clear from the look to a reasonable person that that space is just for your office. Now, there are two ways, just like with the car expense deduction. to also deduct your home use of business use of home, I'm sorry. So the simplified method, you just multiply by 5 each square feet of the space that's used exclusively for business. Now you're limited at 300. So the most deduction you can take with this one in a year is $1,500. So it's not a lot, right? Especially if you're in pricey areas such as Silicon Valley or New York or, I don't know, Florida. So in those cases, you can use the regular method. So what you would do, you will take the rent, or if you are paying mortgage, you will actually take the depreciation of the house plus the interest times the square feet used for business divided by total square feet. Now you can also include expenses for maintenance of your home, right, in this one. You can also include expenses such as property taxes, such as like renter's insurance if you're renting your space, right? So basically the point is all the expenses done to maintain your house, right, are multiplied by the proportion of your house that's used exclusively for business. Now, other expenses, such as can you deduct your phone? Can you deduct your Wi-Fi? Can you deduct your business meals? Now, depends. So most people will use their phone, especially for a small business, right? Both for personal and business needs. Now, if you have a separate phone just for business, then yes, it's 100% business expense. You deduct every penny you spend on your phone, also your coverage, etc., etc. Same with Wi-Fi. If you have an office and you have an office Wi-Fi, it's 100% deductible. However, you're working from home or you're using your cell phone, personal cell phone for business. In these cases, you would generally deduct 50%. So you spend $1,000 on your phone bill a year, you will only deduct 500. Business meals, right? So this is not your regular lunch, right? So let's be very clear about it. Your lunch is not deductible. However, if you see your clients at Starbucks, at a restaurant, or you want to buy some food for your clients while they're in your office, this is deductible at the rate of 50%. But this is important, right? Because when you go to a restaurant, you also eat, you also get entertained, right? You also get the benefit of being in a restaurant. So it's not just a business expense, it's also leisure, right? So therefore, only 50% of business meals are deductible. Now, other expenses, obviously employee wages. If you have employees, you pay them salary, or that's 100% deductible. Insurance premium, so you pay for insurance for your employees, that's 100% deductible. Other benefits such as retirement plans, such as perks such as gym memberships and all that stuff that employees may get in addition to their regular paycheck is tax deductible. You have contractors or suppliers, you pay them, that's tax deductible. You buy tools and supplies, that's tax deductible. If you have an office for business, your rent is tax deductible. Or if you own the office and you pay mortgage, the depreciation and interest are deductible. So these are basically the most common types of business-related expenses. And if there are any questions, if you want me to elaborate more on any of this, I'm happy to do so.
Thank you, Tigran. I have a few questions to you. What documents do I need to collect to report the taxes?
It's a great question. So generally, receipts or invoices are more than enough, right? And the way the process works, you do not have to send any receipts to IRS directly unless IRS requests it, right? So when you file your taxes, depending whether you're a corporation or sole proprietorship or a partnership, you will report your expenses in appropriate forms, right? So basically you will write, I spent $100 on gas, right? I spent $50 on my phone, right? So, and then IRS will generally accept that. However, IRS reserves the rights to audit you within 7 years, right? And if IRS audits you, you are required to show reasonable proofs. Reasonable proofs can be checks payable to your suppliers or wherever you bought the stuff, can be receipts you received from stores you bought stuff, can be invoices, can be rental agreements if we're talking about like home use of business, right? Can be if we're talking about your car, right? So this is actually a good one, right? So how do you prove how many miles you drove, right? Obviously it cannot be more than your odometer, right? But also generally it is recommended that you keep a log of the miles you drove every day, right? So Today, you drove 20 miles for your business, do it electronically, do it on paper, but have it, right? So say on December 4, I drove from point A to point B, and it was 15 miles, and it was for business, right? So as long as you can show something like that, and it seems reasonable, it makes sense to IRS will not disallow any of your expenses.
Can I keep it digitally? Because in my storage, I have so many receipts, and I probably would want to get rid of them. And many entrepreneurs don't want to keep that amount of receipts for many years. What can I do about that? Can I just make copies of that, keep it digitally somewhere? How would I do that?
Yeah, in most cases, you can keep digital copies, especially if it comes to like supplies and stuff that businesses buy on an everyday basis. Yes, digital copies are totally fine.
Can you come back again on the process of how to report these taxes to IRS? What exactly the documents needed and how to submit it? And of course, where IRS is going to look into the reports, what they're going to check. So it's just important for entrepreneurs to emphasize on specific things that IRS is looking at, of course.
It obviously the form depends on your type of the business, right? So legal structure. Sole proprietorships will use Schedule C. Partnerships will use the form 1065. Corporations will use form 1120 or 1120S if it's a S corporation, right? Now, each of these forms have something called a profit and loss statement, right? So if you've ever taken accounting, right, you're probably familiar with that. Profit and loss statement basically says how much money you made, that's your gross profit, right? What are your expenses, right? And then what's your net income, right? So basically, you will say my gross income was $100,000, right? Then there'll be different articles for you for your expenses, right? Let's say advertising, right? I spent $10,000 on advertising. Car expenses, I spent $20,000 on car, right? Uh, Home use of business, right? I spent $5,000 on my home use of business, right? At the end, you will say my total expenses were $35,000. So my net taxable income is $65,000 as a result, right? And so that will be your profit and loss statement. Again, 1120 if corporation, 1065 if partnership, Schedule C if sole proprietorship, right? And all these forms are available for download at irs.gov. So these are the forms you will fill out. And then the net profit on those forms will be what you pay taxes from.
Wow, you've just saved so much money just with this short video. And it's not just that. We have prepared another video that you can see this in this link where we guide you how to file taxes yourself. So you don't have to hire consultants or anyone to file it on your behalf. You can try to do it yourself. And many entrepreneurs already use that video to really file it. So you can do it. Of course, you need to be very careful, but it's doable. So just if you would have questions, just ask here in the chat, and Tigran and myself, first of all, Tigran will be happy to answer your questions and give us your feedback. So maybe other topics you want to know on this in this sphere about taxes or maybe accounting, maybe something related to that, or startups, fundraising, or something else. Let us know what you want. We will help you with that. We'll find the right experts and we'll probably build or do another recording of something that really can help you. This is the goal of this channel, to help entrepreneurs. Now, that's it for this part of the topic. And Tigran, do you have anything else to share with our audience?
I guess it's December, right? So don't wait until April, right? So if you wait until April, there's nothing you can do, right? So right now, maybe talk to your accountant, right? Or try to figure out yourself. You look at your bank statement, your profit and loss statement, and see if there's something you want to buy. It's actually a pretty good time to buy now, right? In December, because if you do it in January, you won't be able to deduct it for another year.
And that just saved you another amount of money. Tigran, what are the deadlines for tax filing for C Corps, LLCs, or proprietors, for personal taxes? Give us some clarity on that because it seems like not many people know that.
Yeah, for most tax returns, the deadline is April 15. So corporations, it's April 15. Personal taxes, April 15. Now, LLCs, depending if it's a partnership LLC, it will be due on March 15. If it's a sole proprietorship LLC or a corporation LLC, it's April 15, right? So basically, partnerships, March 15, everything else, April 15, right? And also important to remember that your franchise taxes, if you're in Delaware, are due on March 1st, right? But check with your state to make sure you're not late on your franchise tax.
It's a good point. So all taxes must be filed by April 15th. However, the deadline for franchise tax is the March 1st. Well, it definitely help you guys to avoid some extra fines or something. Tigran, I have another question from entrepreneurs that wants to know that do they need to report taxes every quarter? Some of them are thinking like, do we need to report it by the end of the year or with the other, not a calendar year, but fiscal year? So what is this? Can you elaborate on that so people can understand?
There are a few exceptions. Now, when it comes to, it's important to make the distinction between reporting and paying your taxes, right? Now, reporting is when you send your tax returns. Paying, so generally speaking, if you owe more than $1,000 in taxes, right, you're required to pay your tax bill every 3 months, right? So you should not wait until April 15 to pay your taxes. Now, having that said, many people still would wait until April 15 and pay their taxes then and pay a small penalty, which is roughly 2%, right? So generally speaking, yes, if your tax liability, you expect your tax liability. And the tricky part is that how do you know if you're going to pay over $1,000 in taxes, right? So that's the tricky part, right? So in those cases, IRS would expect you to make estimated payment and also how much is my estimated payment, right? So many people, not to deal with all that stuff, they just pay 2% extra and they just pay everything on April 15, right? So now, other times when you need to report, that's the wage report, right? So if you have employees, you would need to send wage report every 3 months to IRS. But generally, if you're using a payroll software, and most of companies do, your payroll software will take care of it for you. So practically, you don't really have to worry about sending quarterly reports to IRS.
Thank you so much, Tigran. We covered another great topic for entrepreneurs. Guys, this is the top content we create for you. So press the like button. This is super important. Just go and press this like button, please. Subscribe to the channel. Spread the word about Go Google World, our video. Share it on your social media. It will help us because we invest so much time to create these kind of videos, and you need to support us. This is really important for us. We really appreciate that. And of course, leave your comments here and subscribe to the channel. The more you do for us, the more we create it for you. This is how it works. We'll see you in another video. Bye.